Welcome to The Explainer. Today, we're going to dig into a hidden risk that connects one of Wall Street's most basic jobs to the super high-stakes world of volatility trading. Let's jump right in. Okay, so let's kick things off with a trading strategy that, honestly, seems way too simple to actually work. It's called a short-term reversal strategy. And look, the idea is super simple. You just systematically buy stocks that have recently taken a nosedive, and at the same time, you sell stocks that have just skyrocketed. The whole bet is that these big moves will, on average, kind of snap back. And here's the wild part. For decades, this dead simple strategy of buying the losers and selling the winners has pulled in a surprisingly high average return. We're talking about 10% a year. And that brings us to the big question, right? In finance, high returns almost always mean high risk. But with this reversal strategy, the risk just isn't obvious at all. So where is it hiding? To find that hidden risk, we've got to understand the people who are basically running this exact strategy every single second of the trading day, liquidity providers or market makers. Their whole job is to be the buyer for every seller and the seller for every buyer. And for these folks, their number one nightmare, the thing that keeps them up at night, is something called adverse selection. It's this constant fear that you're unknowingly on the other side of a trade with someone who knows something big that you don't. Think of it like a high-stakes poker game. Someone across the table shoves all their chips in. You look down at your cards, you think you have a strong hand, and you call the bet. Then, bam, they flip over a royal flush. You didn't just lose to bad luck. You lost because they had better info and knew you were beat. That, right there, is adverse selection. So how in the world does a liquidity provider know when they're at risk of being the sucker at the poker table? Well, the academic paper we're exploring today offers this brilliant clue, captured right here. Information generates volatility. The link we've been searching for? It's market volatility. To really let this sink in, let's just put ourselves in the shoes of a market maker for a minute. It's been a busy morning. You've been doing your job, absorbing this massive wave of sell orders. The prices were dropping, and you were the one on the other side, buying them up, building a big position. Then you look up at your screen and see the VIX index, Wall Street's fear gauge. It just spikes. The entire market suddenly gets a jolt of anxiety. Now, what does that have to do with the stocks you just bought? So here's the crucial point from the research. That spike in market-wide volatility isn't just random noise. For you, the liquidity provider, it is a powerful and very specific signal. And here it is. This is the hidden risk. That volatility spike is a signal that the flood of selling wasn't random. It was driven by informed traders who knew bad news was coming. The spike reveals that their private information is now hitting the whole market, and you just took the losing side of all of their trades. This discovery just completely reframes what it means to be a liquidity provider. You're not just managing an inventory of stocks. At a really fundamental level, you are making a constant bet against sudden, unexpected spikes in market volatility. You are, in effect, selling insurance against market chaos. And the data backs this up perfectly. What this table shows is that the reversal strategies are a proxy for liquidity providers. They lose a lot of money precisely when the VIX spikes. In financial terms, they have a big negative exposure to volatility. When chaos goes up, their profits go down. This leads to a really powerful, kind of beautiful conclusion. The money earned for providing liquidity, the liquidity premium, isn't some mysterious extra profit. It's the exact same payment that other investors make for protection against market chaos, a payment known as the variance risk premium. They are two sides of the same coin. And the paper confirms this in a really stunning way. The researchers calculated the price of this volatility risk in two completely different markets. They did it once in the stock market using our reversal strategy, and then again in the options market. The result? The price was identical. So what are the crucial points to take away from all this? First, that simple reversal strategy is a fantastic stand-in for what liquidity providers do. Second, its profits are just compensation for a hidden risk, being short volatility. Third, a volatility spike is like a flare gun telling you that you just traded against someone who knew more than you. And finally, providing liquidity is basically the same thing as selling insurance against market turmoil. The big picture implication here is really profound. We now have this powerful, unified theory that connects the basic plumbing of financial markets, the simple act of buying and selling, to one of its biggest and most important systemic risks, volatility. And this leaves us with a provocative final thought. If the profits from one of Wall Street's oldest activities are really just an insurance premium in disguise, what other seemingly simple market returns might be hiding a similar secret? What other risks are we getting paid to take on without even knowing it?